data that's just being generated globally. I mean, you will have seen that sort of animation up at the beginning of the presentation. But, you know, we're nearly in 2020 now, and, you know, at the moment, in this, what they call the data sphere, we're adding about 1.7 megabytes per human being per second, which basically means it's more than 40 more bytes there are than stars in the observable universe. You know, and the growth here is exponential. So by 2025, we're going to have kind of people interacting with connected devices 4,800 times a day. So, you know, I think the average person looks at their phone probably a couple of hundred times a day. So 4,800 doesn't leave you with much free time. But yeah, I mean, obviously this is self-driving cars, and there's you know, technologies we haven't even understood yet. And a quarter of this data will be kind of being produced in real time. Most of it will be analysed on the fly and then thrown away. We just can't kind of store these volumes of data. But yeah, by that period, we're getting about, you know, over 200 million DVDs worth of data being produced per day, which is extraordinary. Okay, so, you know, where is this all happening? I mean, you can see it's all around the world. You know, Europe, Middle East, and Africa are that sort of the mid blue one there. And where is all this being stored? Well, I suppose it's historically been sort of on company premises or on your hard drives and so on. But it's overwhelmingly going to kind of exist in the cloud environments. And, you know, in South Africa, just recently we've had earlier this year, Microsoft Azure opened kind of cloud data centers in South Africa to serve the African market better. And Amazon's had data centers here for the last couple of years. So, I mean, we're well positioned here in terms of generation of data, the location of data, and ability to work with it, to participate. Okay, so, I mean, the challenge and the upside here is that, I mean, at the moment, only less than 0.5% of this data is actually analysed and used that we're currently working with. So there's probably a bit of an 80-20 rule here where 20% of the data is actually giving us the most of the insights, but there's still a huge amount of data which you know, there's value to be had there and kind of mined out of it. And that value, you know, just looking across a couple of industries here, says that, you know, on the health side, if we're able to actually understand the pathways that people navigate going through the health system, what's happening to them at each point, if we can kind of predict things that are going to happen to them clinically or in the environment, we could save over $1,000 a year per person. You know, just the data accessibility as well, making it accessible within an organization, it can add huge value as well. And on the retail side, you know, just being able to kind of predict what customers are going to do more accurately, tailor offers to them, manage supply chains more efficiently. You know, you could have massive increases in the operating margin. So, I mean, even if kind of most of you are sort of actuarial or investment professionals, I mean, these types of dynamics are transformative. You know, even if you're kind of looking at investing in firms, like to understand which firms are going to kind of reap the rewards here and which ones are going to be reaped by the other firms. So so this is sort of critical stuff to understand. You know, so these are the opportunities. I think some of the threats were mentioned as well, like what's this going to do to kind of jobs. And there are a lot of different estimates from kind of World Economic Forum and McKinsey and so on, you know, ranging from sort of 50% to 70% of jobs, as we know them, are going to be lost, okay? As this sort of artificial intelligence is able to sort of replace service jobs as well as, you know, more manual jobs. So, and then this is true in kind of, you know, industrialized as well as industrializing countries. So, I mean, there's a great opportunity here if you have the skills to navigate this environment, but obviously a threat if you don't. And so, yeah, I mean, so really the skills one needs, I think, at some level to sort of survive in this environment are some appreciation of data science. And I suppose with data, we're saying, we've got these historically vast quantities of data, and then science obviously is about testing hypotheses, running experiments, analyzing the results, drawing conclusions, building kind of software that runs without kind of a human intervention. So, I mean, most people sort of understand by data science, machine learning, but there's a lot of other aspects to it. So just visualizations can give you a lot of great insights into your data and help you draw conclusions. Many people probably heard of like deep learning, using kind of massive neural networks to do tasks that have historically could only be done by humans. So visual recognition of things, sound, recognizing information from sound and so on. And then optimization is a key one as well, like taking a very kind of complex system like a business or a logistical supply chain and kind of optimizing the best way. Trucks need to move in a system to deliver goods, for example. Okay, so that's sort of data science, and obviously to navigate that environment you need to some extent be a data scientist. We see there being three main components of a data scientist. So one is some appreciation of kind of statistics and algorithms. Second one is some appreciation of software engineering or ability to understand that field. And the third aspect is I suppose soft and people skills. So this is understanding the problem you're trying to solve and communicating the answer back to the client. And then there's actually a fourth one in the middle, which is just having a business mindset to connect this all, in a pragmatic way that solves the problem without over-engineering it. For this, you could come from several different backgrounds. So it's actuarial science, stats, applied maths, whatever. I think most people will have had some exposure to computer science in various forms and coding. I think we heard that mentioned earlier. And then I think a lot of people would be getting these skills through many of the other courses too. So I think people in this room are probably fairly well positioned for this environment. This is a skill I think most people should have. I think for almost any career going forward, and to kind of get into this. How many people here have had sort of some programming experience with like R or Python? Okay, so a reasonable showing, but these would be probably your entry points just into kind of understanding the language. Java is a critical one, which was mentioned earlier, but particularly when this sort of stuff goes in production. Scala is another language to run these sorts of things at enormous kind of scale, and the Spark framework as well. But these are probably your best intro ones. And then, how many people have used kind of Coursera or Udemy or those sorts of? So these are these kind of massive open online courses are an amazing resource. That's how I started, was doing a machine learning course through Coursera. So they're really high quality, and you can get sort of certificates off those as well, like once you've completed them. So they can go on CV too. Cool. So anyway, that's just my intro of the fourth industrial revolution. I suppose some of the trends, some of the sort of the really exciting and also kind of frightening changes that it's going to make, and what are the sorts of skills people will need to handle that. All right, thank you.
So my little clip here is a segue. What happened?
That's what's supposed to be on your screen.
Yeah. I don't know why it's not in presentation mode, but so it's fine.
It's because we do.
Yeah. So what I wanted to do was just maybe set out for you. We talked a little bit about the entities in the discovery group, just to give you a sense, if you're not familiar with it, as to how this has developed and evolved, as we said in the beginning, starting with the Discovery Health Platform, and that's starting with the Discovery Health Platform, and of course the behavioral aspect of it, which is this chassis which underlies it all, which is vitality. So in the South African environment, we have then the various entities, starting with Discovery Health, and then once Discovery Health was up and running, Discovery Life came into being. So Discovery, as a very large organization, is constantly in this sort of entrepreneurial development spirit. Once Discovery Life was up and running, then along came Discovery Invest, and then we had Discovery Insure, which is the short-term insurer, and then of course most recently the bank. Meanwhile, in the middle of all of that development, then the developments were also starting globally. So in the UK, the brand for Discovery's businesses is the Vitality brand. So you see that sort of hot pink brand there of Vitality. And similarly, in the UK, started with Vitality Health, and then built Vitality Life, and then Vitality Invest is now up and running in the UK as well. And then entering into partnerships across the globe. So Ping An Health in China is of course one of the fastest growing markets. I don't even have those numbers in my head, but it's quite remarkable the volume at which those businesses are growing. And then a number of partnerships across the globe in terms of countries like in the US, in Germany, and in other countries in Europe. And so all of this is based on this chassis of Vitality. And what is Vitality about? Well, what underpins the Vitality model is this kind of inspirational framework. And it's built on this principle of shared value. And this is a good way to describe shared value from a business structure point of view. That in many cases, when you look at how businesses are structured, first of all, they define what they do, and very often they let what they do define them, okay, whether they're a manufacturing company or whatever it is that they do. Perhaps then they move a little bit higher up in terms of almost an order of development and think about how they're doing what they do. But we feel that most significantly is to also think about the why and to think about the impact on the community and the environment that we're working in. And of course, if from a business development point of view you focus on the why, then actually the what and the how, they follow. So if you're delivering value, then you will always have a business, regardless of what it is and how you're doing it. And so as long as there is always that focus on the why, and that's kind of what underpins the core values, which have meant that Discovery was able to build from this health platform into the range of other businesses that you've seen. So if I describe this here in terms of the kind of trends that we see in insurance risk, that this value statement that you see in the middle of the slide, making people healthier and enhancing and protecting their lives, that's kind of the why that is the center of that sphere. And from that, you can see the different elements in terms of the health business, in terms of the life business when it comes to protecting, also the insurance business, and of course invest in terms of protecting people's futures as well. And part of what the bank is doing is bringing that together in terms of a more broad approach to financial management. So it's about creating this ecosystem which is built on this shared value proposition, because if you are delivering on that kind of core purpose that you see at the center of the slide there, then the value flows in terms of value to the customers, but also then value to the other stakeholders, being the shareholders and, of course, the people who are working in Discovery as well. So let me just talk a little bit about how that Vitality chassis plugs into to the business. So for members, obviously, you want to make this something that is that they enjoy participating in. I mean, we know that often with financial services, we talk about a grudge purchase. You know, something that you feel like you must have, as opposed to something that you want to have. And I think what Discovery has been really successful in doing is flipping that around a bit in terms of demonstrating the value that protection has, and sort of encouraging and incentivizing people to do the right things and to make good decisions. But of course, it's not just by fluke. There's a lot that goes on behind the scenes, and what Simon's presentation gave you was some insight in terms of sort of the grey bits there at the bottom. So perhaps not all the sexy stuff that you see in the presentations, but the hard work and the analysis that goes in to actually defining those algorithms. I mean, if we're going to be effective in terms of, for example, behavioral change, then we need to have really good understanding of what the triggers are, and make sure that the data supports the investment in making those behavioral changes. So make no mistake that when you look at the rewards, for example, that the Vitality program delivers, there's a huge amount of science and analysis that underpins how those rewards translate into value, and particularly, of course, value for the customers. And it's not just about that value from the point of view of the financial results, but also value in terms of making sure that people are going to be persistent in their participation in the program. So understanding, what gets people interested in participating, what keeps them interested, and of course what motivates them to do what's ultimately the right thing in their own best interests. Wanting to push the wrong keyboard. So that really is what drives the Vitality shared value model, and of course, because we are an organisation that was founded and has been grown on this actuarial platform, everything has to be translated into a formula. So you'll see here at the bottom this really nice formula, which is talking about the value to the member from the point of view of a customer. And the way that the formula works is you say, well, you create an incentive for the member, okay, and they obviously that means that they want to change their behaviours. The incentive leads to behaviour change. The behaviour change leads to a change in the risk, in this case measured by QX, which is your mortality rates, but it could be morbidity rates. It can be your driving style, and of course then that behaviour change or that change in the risk then leads, of course, to value. And I'm sure you've all seen that if we then the wrong keyboard again. If we apply the common factors, then we see that that's how we get the value to the member. So effectively, the analysis that underpins all of this is understanding each element of that formula and applying it in the different areas of the business. Whether it's in health, whether it's in insure, and as Matt's going to show us, also in the invest space. And so it's about the structure of the appropriate incentives that are going to lead to the appropriate behavioral change, and of course then that's going to have the knock-on effect in terms of the risk. So that's kind of your whistle-stop tour of the shared value model. And certainly it's been quite well documented and recognized globally. I'm sure you've heard, for example, that Adrian Gore does a case study at the Harvard Business School on a regular basis, and so it gets lots of exposure. And I guess that's what's really led to a lot of those global partnerships. But of course, still very firmly rooted in South African soil. And certainly all the more so in our nice new building where we have our home. So I'm going to hand over now to Matt, who's going to take us through a little bit more of the application on the invest side. Thanks, Matt.
Thanks so much, Roseanne. So earlier Simon said that I'm an actuary myself, and he said that we all have to be data scientists these days. I thought that's very interesting, and it's very important because I work in marketing now. I'm a marketing actuary. I've worked in product development before and valuations, but even as a marketing actuary, we deal with mountains of data. I'm going to go through a presentation just now, which is going to show a lot of really interesting insights about investment markets. In order to get those insights, we have to go through mountains and mountains of data. We are scientists, data scientists. We have an hypothesis, we test the data, and we come to a certain conclusion. So going forward in the future, there is mountains of data available. So you mentioned our partner with Ping An, and you said you don't remember the stats. The good thing is I do. So just to give you a clue, Ping An Life Insurance has 100 million life insurance policyholders. 100 million. So that's almost twice the population of South Africa in life insurance policies, right? They have the capability to write 60,000 policies every minute on their applications. And to give you an idea also, they have 1 million advisors, right? So that's 1 in every 1,000 persons in China is a Ping An advisor. So they really are huge. And the scale of that is quite hard to comprehend for us, because I think Vitality Health has, 20 million members, right? And these guys are growing at that almost every 2-3 months. So by our whole membership. So the scale we're seeing in China is huge. And we keep on talking about this fourth industrial revolution like it's something that's going to happen in the future. But actually it's already here. So to give you an idea, China is probably one of the most digitally connected societies in the world, if not the most digitally connected society in the world. And how do we know this? Well, for one is that the concept of hard currency or cash has completely disappeared in China. About a year ago at the Actuarial Convention, we had the deputy CEO of Ping An come and talk to us. He also was an ex-Discovery guy, moved across there to help set up the Discovery chassis there in the Ping An business, and ended up becoming the deputy CEO there. And his insights were really funny. He said that the concept of cash has disappeared to such a degree that when street performers perform on the side of the road there, afterwards, instead of walking around with a hat and collecting money, they walk around with a QR code, and people scan to donate money to them. So on that note, my QR code is outside in the hallway afterwards if you're enjoying my talk. That's just a joke. Great, so let's suck in now. I'm going to talk a bit about how behavior fits into investments, right? We've heard our Discovery, it capitalizes off behavior in order to create the products that we have. So I want to talk a bit about how that works in investments, because I think there's a very obvious link in health, and that seems very obvious in life insurance and health and short-term insurance. But let's talk a bit about how that fits into the investment space. So first off, I think many of you in your studies have come across this idea of behavioral biases and how they shape our everyday decisions, right? There's a bunch of them that affect our everyday decisions. Here's a few on the slide here. So this pointer does work, huh? So I'll press. Okay, great. So I'm going to go through a few now and show how that affects our actual investment decisions. But first off, a fun little slide. So this is from a Harvard Business School study, just showing how people are overconfident, right? This is one of the behavioral biases we face day to day. So one of the questions they asked was, obviously there's only 1% of people in the top 1% of wealthy people in the world, right? But when they ask these people how many of them think they're in the top 1% of wealthy people in the world, instead of 1%, 19% think they are, right? We also overestimate our relevant intelligence, right? So obviously there's only 50% of students that can be in the top half, right? So, but when asked how many of them think they're in the top half of intelligent people in the room, 80% think they are, right? We also overestimate our relative attractiveness. Again, when they ask people whether they are above the median attractiveness, 85% people think they are. So clearly we are overconfident, right? And this will obviously affect our investment decisions. I mean, if you talk to any person, especially people in the investments industry, not a single one of us will admit that we don't know what we're doing when we're choosing investments, right? We'll all pretend like we know what's going on. When I remember with the Bitcoin craze going on, and everyone's going to it seemed like everyone understood how everything worked in Bitcoin. And as it turned out, when everyone was investing, everyone was talking about it, there was a massive crash in the market. Clearly not everyone knew what they were talking about, right? But we see that in our investment decisions day to day. Here's another interesting one, anchoring and adjustment. You might have heard of this one before. This is also from a study by Strack and Musvika, I think his name is. Anyway, what they asked is what an anchoring adjustment is. And anchoring is when you first pin someone's expectation. It can be any arbitrary kind of anchoring. You anchor the expectation of what an estimation should be, and then you ask them the question about what they estimate it to be, right? So they'll take that anchor, they'll pin the expectation of that, and we find that even if it's an arbitrary anchor, it will severely affect how people approximate the question. So for instance, here's one. They asked the people, did Mahatma Gandhi live beyond age 140, right? Did he? No. Okay. So how old was Mahatma Gandhi when he died, right? Who says he was in his 50s? Show of hands. 60s, 70s, 80s, 90s. Okay, right? So we were in the 80s, 90s region, right? Indeed, in this kind of test, the median answer was about 67, and we were a bit high in the room, which is good. Okay? When they did the exact same question with a different pin, they said, did Mahatma Gandhi live beyond age 9? Right? Yes. How old was Mahatma Gandhi when he died? And the average answer dropped significantly. So even if the anchor is completely arbitrary, it affects the way we approximate. So he was 74 when he was assassinated. And so anyway, what we can see is that when we ask these, even the arbitrary pin will severely affect how we make an approximation. That also affects our investment decisions, right? A lot of our investment decisions are anchored based on past performance or past experience, and that determines significantly how we will choose our investments going forward. I'll show a bit more about that now. So when we make an investment decision, there's generally 3 key things we think about, right? First is the risk we're willing to take. The second is the return that we want to achieve. That also affects like the risk we want to take. And then finally, the cost of that investment decision, right? And how much it's going to cost. So let's dig into each one of these decisions and how behavioral biases can actually affect that. So first, from the point of view of risk. Right, so if we look at, for instance, past returns over the last 2 years of local equity versus cash, right? What I'm going to show you is how risk often, and I've talked a bit about anchoring and adjustment, but also there's something called loss aversion, right? We as humans naturally are risk averse to losses. We do not want to experience loss, right? We want to run away from loss. So this often distorts our perception of risk-reward relationships, right? So here's the last 2 years of returns, local equity versus cash. We can see local equity is up and down, up and down. If anyone's been following the equity markets the last few years, it's been very volatile and flat overall, right? And that's what we see here. Versus cash, which has consistently provided a small return, right? When we look at those numbers, indeed we see local equity, low returns, annualized returns over the last few years, and high volatility, right? Versus cash, which is, just inflation beating returns at a very low volatility. Based on this information, right, which investment would we want to choose? Right? Cash, okay? And so that's your loss aversion speaking. That's also your hindsight bias speaking, and that's also your anchoring and adjustment speaking, right? And indeed, what we've seen in the markets is people are overwhelmingly choosing cash. So we see most people are putting their money in interest-bearing instruments or cash, right? 55% of flows over the last 3 years. And that's 2.5 times the amount that's gone into balanced funds, which are more risky, diversified investments that should give you long-term real returns. The problem with this is that if we actually look at the data of markets going right back, right, and we look at the highest cash returns ever achieved in the market, I mean, this is going back to long ago. Can't remember, it was like 1990 or so, but longer. If we look at the highest money market returns achieved over different investment periods, right, there's 3 years up to 10 years. Okay, we see it starts out, you get the highest return you would have gotten in 1 year is about 9.3%, and that kind of averages out over time to around just above 7%. But if we were to compare that to the lowest equity return ever achieved over those different periods, right, we see that after 6 years, you are, historically speaking, you're strictly better off being in equity. The lowest possible equity return you could have achieved over a 6-year period or longer, historically, has beat the highest cash return you could have possibly gotten, right? Indeed, when we analyze the actual equity returns over time, we see that the lowest equity return and the highest equity return, as term increases, converges, right, more towards the median equity return over those different periods. And we see so much so, in fact, that when we get to around a 10-year term here, we see that there's only a 3% difference in return between the top quartile and bottom quartile returns. So over time, not only do you achieve much better returns in growth assets, but also with higher certainty, right? So actually, it's completely illogical for someone in a long-term investment to be investing overly conservative. But that's what we see. Let's take, for instance, we did an analysis on our living annuity book, right? And living annuities are long-term investments, right? If you take out a living annuity at age 60, Gold and Diamond Vitality members are expected to live around age 90. That's a 30-year investment term, right? So from the data I've just shown you, clearly you should be in a bit of a more riskier investment, right? Because it's higher returns over a long time. But what we actually do is when we segment our living annuity book into different investment strategies, from more conservative to more aggressive, right? Volatility is on the x-axis here. Each one of these data points represents our living annuity clients. Overwhelmingly, they are in conservative allocations. So it's showing that people are letting these market movements pin how they make those investment decisions, right? So clearly, but what we know now from the data I've shown you is that likely these people are not going to achieve desirable investment outcomes. They should be investing more aggressively, but those are the behavioral biases speaking there. Next, let's talk about return. One of the key things that affects return, I touched on it briefly, is this idea of hindsight bias, right? We have this feeling that even though we know that past returns are not a good indicator of future returns, we still have this insatiable desire to want to choose investments based on past performance, right? But let me show you why that's not a very good idea. Here I took a random fund. Well, actually, I selected the fund, but it's from the CISA multi-asset high equity sector. And this is a snapshot of that fund performance at 31 December 2017. I won't name whose fund this is, but here's over different investment terms, right? Looks like a great fund, right? Top quartile performance. The gold bar there is the top quartile performance, and the blue bar is the fund's performance. So clearly a very good performing fund. Might be inclined to believe that this is the fund you should choose, but if we look at the performance 1 year later, so different view. In fact, the fund performed horribly over the year ending 31 December 2018. So badly, in fact, it pulled all the returns out of all the other investment periods right down. Right? So clearly hindsight bias is a very dangerous thing. In fact, what we did is we did a statistical analysis of the entire CISA multi-asset high equity sector going right back. No, sorry, not right back. We looked at the performance between 2009 and 2013. Oh, sorry, we've lost some brightness here. Is that because? Oh, it's just the lights. Okay, versus performance between the period 2014 and 2018. Right? If you chose a fund that was a top quartile performer between 2009 and 2013, the probability of it being a top quartile performer in the next 5-year period is only 6%. In fact, coincidentally, that's the exact same probability of you having chosen a quarter 4 fund that became a quarter 1 fund in the next period. Right? So again, hindsight bias. It's not the best way to choose funds. Finally, in terms of cost, right? There's also, I've talked a bit about overconfidence and about estimation and how that affects our estimations of things and anchoring adjustment, etc. It's a very hot topic in investments at the moment, is the topic of fees, right? But the problem is that people overestimate the impact of fees. And let me give you an example here. Right, in the graph here I have an idea of what an expectation would be, right? So let's say, for instance, there's 2 different funds that have 2 different fees, right? Let's say they have, I think it's a 1% fee difference or something like that. What we'd anticipate is that the more expensive fund, right, would underperform the cheaper fund, right? We'd anticipate that over time that gap would kind of grow. But in reality, what we're not accounting for is the fact that high fees exist for a reason in an investment fund, right? You're rewarding the manager for the returns they give you. So it's not necessarily true that just because a fund is cheaper, that it's going to perform the same or better. The underlying assumption there is that they perform the same, right? Case in point, we took a fund also, 2 funds, a cheap fund and a more expensive fund in the industry, 1% fee difference between them, and we looked at the performance. We actually see that the more expensive fund much outperformed the cheaper fund. And remember, as I said, I think the fee difference is 1% down here. In fact, so much so that over a 10-year investment period, the more expensive fund outperformed the cheaper fund by 77%. So clearly, we think we have overconfidence about when we estimate things, and especially when it comes to fees. So we did the same analysis that we did before about performance in one period versus another. We looked at a TER of a fund, which is the kind of proxy for the fee of that fund, versus the performance over a 10-year period. So this is the fee at the beginning of the 10-year period versus the performance. What we see is that if you had chosen the cheapest fund at the beginning of that period, you only had a 4% chance of achieving top quartile performance, right? It's Q1 cheapness. And again, that is the same probability of having chosen one of the most expensive funds and achieving top quartile performance. So clearly, again, fees aren't a very good proxy for performance. All right. So clearly, this investment formula is subject to these biases, right? And we're at danger of making bad choices because of our biases. So what is Discovery's solution to overcoming behavioral biases? This is where our behavioral investment models come in. We actually believe is that making the choice based on just performance, risk and fee and cost is not sufficient. In fact, behavior is a much better way to address investment outcomes. So briefly earlier, Roseanne touched upon the Discovery model, the shared value model. What we pretty much said is we said that controllable behaviors, right, and in the invest space especially, 3 controllable behaviors lead to 3 conditions which lead to 90% of people not making their retirement savings goal. So I don't have time to go into each and every one of them, but this is an overview of how behavior underpins each of the businesses in Discovery, right? In fact, in investments, behavior is very important. Vanguard, the huge investment group in the US, did a study about the impact that advisors can have on investments. What they found is that by far the biggest impact an advisor can have on investment is this idea of behavioral coaching. That's the advisor coming alongside the investor and ensuring that they have the right behaviors. I talked earlier about 3 behaviors, right? In Invest, we've identified them as people need to invest for long enough, they need to save enough, and then make sure they don't withdraw too much from their investment. If the advisor can help a client do that, they add huge value to investment. Vanguard reckons it's 1.8% per annum in excess returns just from keeping their client's behavior in line, not withdrawing when markets drop, making sure they stick the course of their investment journey. So let's see how Invest's behavioral model plays out, right? So we know in the healthcare space, we've seen this before, right? In the health side, we know that the status quo is to not want to exercise and not want to do anything. Similarly, in investments, the status quo is, I don't have enough to invest. I can invest later. I need to withdraw this money now, right? In the healthcare space, we address that by, we know that we want people to exercise more, so we offered these rewards to get people to exercise more. And as a result, people did, tremendously did, in fact, and that changed people's behavior. Similarly, on the investment side, there are the 4 behaviors we are trying to target. We're trying to get people to invest for longer, invest more, withdraw less, and live well. Why? Not just because it's good for the client, this is the shared value thing. It's good for us as well. And we feed back rewards to the client, right? When they perform, when they do good behaviors, we make more money, and we feed it back to the client in the form of rewards. So here's some examples of our rewards. We offer boosts of up to 20% on our investment for clients investing longer. The longer you invest, the bigger your boosts. We offer boosts if you add more money to investments. We give you in retirement income boosts of up to 50%. And those get bigger and bigger and bigger if you draw down less and less from your investments. The more you preserve your assets in retirement, the more we reward you. Similarly, we also reward people for living well through vitality. The result is we've seen changes in behavior, significant changes in behavior from these behavioral incentives, right? People are investing 3 years longer, investing and making more adult contributions, and withdrawing less from their investment. So to give you an example of this whole idea of costs and evaluating things on a classical kind of way of just risk, return, and cost, versus the impact of our model, which is behavior and rewarding people for positive behavior and the impact of that. What we did is we analyzed a 20-year investment, and we calculated what the impact was of a 0.4% fee saving on these retirement investments, right? And we rescaled that down to 100 Rand, okay? So comparatively, if someone just invests 2 years longer, that has almost double the impact of that fee cut, right? If someone just makes a small ad hoc every 2 years, just 10% of their investment value every 2 years, that's almost triple the value of a fee cut, right? Finally, if someone withdraws just 2% less in retirement, just 2% less, that's over 3.5 times the impact of a fee cut. Together, if we put all those behaviors together, it's almost 10 times the impact of a fee cut. We're starting to get the point here. The point is that behavior has a much bigger impact on the client's investments than just simply the rest of the industry's response of just cutting fees. That's why we believe, actually, if we can encourage people to change their behavior, right, the client benefits and our company benefits. This is the shared value concept in action. So to summarize, right, our biases cloud the decisions we make when we invest for ourselves, or if you're an advisor investing for your clients, right? And the choices based on past performance, cost, and market timing, or other kind of classical ways of choosing investments, really actually add or detract value kind of randomly. Versus a behavior change model, which actually can add up to 10 times more value than the traditional approach does. And that's what we're trying to do at Discovery Invest. Thanks so much, guys. Thank you.
Good. Thanks, Matt. So we're getting excited about your questions. So I hope you've got lots of questions building up. But before we get to the questions, I'm just going to ask Sello to come and talk about the talent side of the business, because we have a lot of talented people who are producing these results.
That's pressure if you're clapping before the presentation. But yeah, I think it's really a privilege to speak to all of you this evening and to share with you a little bit about what we as Discovery stand for and actually what we're looking for in terms of talent, because I think you're quite interested to understand how to join us. So really important to mention to you what Roseanne spoke to earlier in terms of our purpose and our ambition. We really want to be the best insurer in the world, and we want to be this powerful force for social good. And we have this commitment. You must have seen the commitment that we put out there in the world to say we want 100 million people to be 20% more active by 2025. And we believe we can do it. We can do that. And we want to make not just the people in South Africa healthier. We want to make the people of the world healthier. And it's a big ask, right? Is it a big ask? We don't think that's a big ask. We think we're going to get that, we're going to achieve this goal. And the reason we think we're going to achieve the goal is because we actually have a foundation. You'll see on the slide up there. In terms of, I should use the pointer, right? Cool. So in terms of the foundation, to help us to achieve our strategy, this foundation there, it's all about having, it's all about having this foundation of the right global platform in terms of the technology, the science, and the data, and I think the team has spoken to that, specifically when Roseanne shared about the chassis that we have and how we're extending our vitality across the world. We also work very hard, and I'm sure you've experienced this in terms of our brand and some of the work we do out in the market in terms of getting our brand out there to our customers as well as our talent, the talent that we want to attract. And yes, we want to be the employer of choice for the critical skills. So specifically in our core business areas, to which some of the disciplines are here tonight, we want to be that employer of choice, and I'll speak more to that. But it all rests upon our values-based culture. Whatever we do as Discovery, we can't achieve it if we don't actually have our values and our culture as the foundation of how we do our business and how we grow our business. So yes, our purpose stays the same. We want to make people healthier, enhance and protect lives. That is what we stand for and the good that we want to do in the world. But I think with all the work that we do, and you'll see there, we've got really great assets that are taking us into the future and propelling us to greatness. But this rests on our values and the people that do the work, the people that embody this greatness that I like to call, we call it the Discovery Lucozade. So if you drink the Discovery Lucozade, we believe that you're actually going to actually aspire and achieve great things. So all of our values are important, all of them, all the 8 that's indicated there. But really tonight I'm talking to you about great people and liberating the best in talent, because you're probably asking, why should I, what should I expect if I have to apply for a role at Discovery? And why is it important why would it be important to have Discovery on my radar? I'm sure that that's on your mind. But like I said, all those values are really important. We offer in our organization really fantastic experiences when it comes to allowing for intellectual leadership and growing your intellectual capability. innovating and obviously coming up with the great ideas that Matt and Simon also alluded to. We do really pioneering, exciting work. If you've seen anything in terms of our vitality chassis and how we've extended that in the last 2 years, it's flippin' brilliant. I don't have any other word to say there. It's just fantastic. And yes, we run a business. I like to say we're not running an ice cream factory. It is a business. We do need to make sure that we're profitable and we're sustainable, and that we do give back to the people that are employed by us, as well as the communities in which we operate in. So business as students and prudence becomes very important. But yes, you are customers. Likewise, we have customers in the world. We still need to dazzle them and make sure that we bring in the bacon. It's very important for us. And of course, there's something that I think our CEO and our leadership embodies, as you would see with the leaders that were presenting here tonight. There's a drive, tenacity, and an urgency. We believe that those things specifically mentioned is what gets us through and gets us to overcome any hurdle or any problem that we have to solve. But we do it all. We do all of this with the right integrity, honesty, and fairness. It's really important for us. What you see is what you get. We lead by example in terms of this value. It's really very important to us, and you'll see that from all our leadership and our employees in the public domain as well. Okay, so I've talked to the values. I'm going to try and save us some time. But really, in terms of discovery, sorry about that, what does discovery offer to people? We want to believe we attract the best talent. So we do attract, grow, and retain the best and the smartest people. But what's really important to understand is that our culture is what, and our purpose is what actually helps us to nurture the talent once they're in the organization. So once the talent is at discovery, once people arrive, and if you're lucky to arrive, you get nurtured by your leaders, and you also get grown in terms of making sure that you inspire as well others to grow and develop. So our leadership philosophy is really important. We obviously want to liberate the best in the people, but we do that in a nurturing, caring, and inspiring way. That is what we stand for as Discovery. And if you've seen our leadership speak, in the last few weeks, our CEO and team issued our financial results. I hope you've seen that. So we do challenging work. We have problems to solve. We have growth ambitions that we want to achieve, but we do it in an inspirational way. We do it with integrity. We do it with the values and embody the culture, obviously, that we want as Discovery. At the end of the day, the last point there, we want to believe that through this nurturing and growing with our talent experience, that we are able to grow leaders, not just for now, but for Discovery into the future and beyond. So, as with all things, I have to present an equation, because I wouldn't then match up to my peers and colleagues. So, what do we want at Discovery? What are we looking for? We want the absolute best person for every role, project, task. You'll see there I speak about role, project, task, and I'll elaborate on that. But people who are able to contribute exponentially to business results. And what this equation says is that really what we're looking for, and it rests on our values. We have a leadership charter which the leadership subscribes to and embodies. And I'm going to share with you just now some Discovery person attributes. That's the foundation of what we look for. What that equation means is that we look for people that have the intellectual capability and competence, so IQ, but we don't want people that have too much of an ego. You know what ego is? Ego can be damaging. We want rather people that are humble, that they're humble enough to admit they're wrong and to fail forward, for example. But at the same time, so we want the IQ over ego greater than 1. At the same time, we want the EQ over the IQ to be equivalent to 1. So what I mean by that is, from an emotional intelligence perspective, how you show up, how you lead, how you embrace and engage with others, you need to be aware of the behaviors and make sure that your leadership style is aligned to our values and what we stand for. And we want that, yes, to be the same as the IQ. We don't want the IQ to be lower. So we're really looking for smart people at Discovery. And at the end of the day, like I said earlier, the IQ also is important, but honesty and integrity are really key to us in how we do our business, how we engage with all stakeholders in whichever platform. That is the key of how we do business. And at the end of the day, for us in the Discovery picture, as I've mentioned, we want to be the employer of choice, and we also want to ensure that we do so having the right technology and that we have a sustainable pipeline. So what does it mean for you? Do you think you embody this equation? Anybody? Hands up of who thinks they embody it. Yeah, that's what we want to see. We want to see confidence. Be confident. Okay, cool. So this is just the Discovery person as I've shared with you. And what's really important here, we know the kind of people that thrive, contribute, and grow at Discovery. They are unique people. They are unique people like Matt, like Simon, like Roseanne. They are people, and I want you to read the second half of that statement. We are people at Discovery who defy the ordinary. We dare to disrupt. So we don't take a challenge and say, that's it. We take the challenge and take it by the horns and we say we're gonna overcome. That's who we are. We're not ordinary. We're extraordinary. So we are people that believe that we can shape the future, and we do it. You can see it with all the enhancements we've made with Vitality and our health business. Look at your app, and you'll understand what type of people they are. Every week, there is some innovation that we put out there, and it's exploding in the market. So that's Discovery. I can't explain it to you better than that. You need to understand by actually using our products and understand how those things are enhanced on a daily basis. So then you'll understand what type of people work for us. They are innovative people. They're disruptive, but in a good way. They're humble people. So what's really important is here, these are the behaviors that we look for. In a Discovery person, if you think you embody those behaviors, then by all means, please take a chance and look for opportunities at Discovery. And if you meet the criteria of that equation, you will be happy one day to be successful to join the organization. So again, values-driven people, optimistic. You need to be optimistic. We believe in glasses half full, not half empty. People tell us something can't be done, we say we can do it, and we'll do it 10 times better, because exponentially we do business greater. That's the Discovery way. Problem solving. Every problem for us is an opportunity. And this is the way we look at finding sustainable solutions for everybody out there. People who learn on the fly. You guys are learning. For us, you probably feel, oh, I'm waiting for honors to end, or I'm waiting for... We're learning all the time. We're constantly learning, we're constantly growing, we're constantly applying our minds. And we believe that through learning, that's how we become a force for social good, and we achieve our ambition. We want results. I think that's really, it stands for itself. Resilience. So I think I spoke to that. Any challenge or any setback, we're willing to look at how we overcome that, and want people to be adaptable, agile, able to deal with experiences that are negative. I spoke to the people savvy, ego, and EQ, and then obviously this is important. People who are trustworthy. You say what you do, and you do what you say, and that type of behavior makes sure that there's trust instilled in you. So we won't overcommit and overpromise. We'd rather underpromise and overdeliver. That's what we do at Discovery. So if you believe you have the attributes up on that screen, then take a chance and apply to the Discovery environment. These are just some of the pipelines. We run Future Leaders programs at the organization from a talent perspective. You would have obviously seen us here at the beginning of the year as well with our visit for the ACFA program, but that's not all we do. We actually are offering Future Leaders programs in all of those pipelines up on the screen. And in the IT environment, we ran a big grad hack recently in June, July, a huge success, as well as then on the other side, all the commercial areas that's mentioned. So we run these programs. They're not necessarily just for a restricted pipeline of talent. You can apply for roles at Discovery through our website and our LinkedIn platform, which I'm going to show now. So, sorry, I'm just going to rush through this. So this is our LinkedIn platform. How many of you on LinkedIn? Not everybody, yeah. It is more professional network. So for people that have graduated or with employment. So I think LinkedIn more on that. I would encourage you to start getting onto LinkedIn if you now at the end of your 4th year or put yourself out there. And yeah, so we have a careers website at Discovery, and you can actually access it through LinkedIn, or you could just apply it through the careers website. So this is our Discovery careers site, and we offer a plethora of roles and careers at Discovery. It's as simple as just clicking on the link I'm going to show you, and it'll take you to our careers page. And yeah, you can go through and navigate and understand what it is we do as Discovery and what we stand for. Okay, so there we are. And we have a wonderful Discovery chatbot up on the screen to assist you, as you can see. So you can ask any question to the chatbot. Okay. So you can go through and understand what we have to offer from a careers perspective. You can also find out about what we as Discovery stand for, and there's a lot of information in terms of Discovery and what we have to do and what we have to offer. So there's enough information. I think it's a matter of you getting out there and understanding what it is you want to do and what you're passionate about. And if you're passionate about something and you have a purpose, and there's an opportunity, when the three align, that is what we call success. When passion meets purpose and aligns with the opportunity, you have something called success. So I would encourage you, after you've listened to all the team that's presented here today, if you're interested in those areas of actuarial science or data sciences or anything in the other areas that I've mentioned from a commercial perspective, marketing, HR, whatever it is, if you have a passion and you're interested, Discovery is the organization for you to work at, and you could apply to them in the future, because our purpose is not just about growing shareholder value. Our purpose is about making people healthier, enhancing and protecting lives. What better way to serve your community than to make people healthier? So please do apply. Thank you so much.
I think we have all heard how the fourth industrial revolution is coming about. We have heard what Discovery is looking for. We now know how to get a hold of them, where to apply, and things like that. So I'm sure you guys have questions now. So we are going to have a Q&A, and if you have a question, can you please raise your hand and tell me who it's directed to? Okay, we have a lot of questions. Let's start from this side of the room, and then we'll come to the middle. Guy in the gray.
My question is directed to
okay.
So my question is, given the fourth industrial revolution now and the biggest scale of jobs being lost, my question is that what does Discovery do, or as an organization, is it feasible for them to, instead of firing people, but to instead give them the skills to actually keep their jobs in a certain extent? Is that feasible for a company?
I think you can come up. I think you will ask each presenter, and then we'll have questions for each presenter.
Yeah, we can.
Or they can all come up, and then you say who is who.
Sorry. Okay, so your question is it feasible for Discovery?
Discovery or a general company to actually give the employees the skills to actually keep their jobs sort of a 25.
Yeah.
Oh, interesting.
Yeah, I mean, I can maybe help with that. It's a good question because it's one of the challenges because you build. I mean, as I said, we invest a lot in people, right? So when a company is employing people, you're investing in them with training and understanding how the products work and so forth. So in fact, it is better to continue to invest in those people and as you say, give them skills, than it is to say, well, now we need to go and start all over again. So yes, I think that's definitely the trend that you will see in the market, which is why that point about, don't expect that when you finish your studies that's it. Even those of you who are studying actuarial science, don't think that once you qualify that's the last of your learning. You know that there's that constant development, and you will often find that in employers that they will have like training platforms. So there'll be opportunities for you to engage with those platforms and grasp those opportunities to build your skill set.
So if I can just add on to that, Alvin Toffler has a saying, you can Google it. It says, the illiterate of the 21st century will be people who are unable to unlearn, relearn, and upskill themselves. It has something of that connotation. But so what we do, what we believe, is that we believe through that, one of our discovery attributes and our values, that people have the ability to learn and upskill and reskill themselves. So we want to give them the opportunity because they've added value in our environment. So we want to give them the opportunity to be upskilled, reskilled, and so on. I think the last resort, any company that's worried about society and contributing to society and being sustainable, the last thing they want to do is to retrench or to fire. I think we want to make sure people are gainfully and meaningfully employed in South Africa and the world, wherever we operate. So we'd rather try first reskill, upskill, but we're also forward-thinking. So we are thinking about the future, to your point, those digital skills that are needed, all the data scientist type of skills that are needed. So I think the last resort is for us to do that. We'll reskill, upskill, and people need to also unlearn and relearn. So that's the other bit.
We don't have a problem with too many employees because we just keep growing.
Was your question answered? Next question, please. White.
I was reading an example about China. China is like a digitally connected world. Like here in South Africa, like who's willing to invest? Because in China they have telecom companies which are investing in 5G networks. Since like they use their WeChat, which is like, for example, steroids.
Yeah. They do everything WeChat, yeah.
In South Africa, like it's interesting what to think about like who's willing to invest in infrastructure?
For starters, we are. So Discovery is investing heavily in digital infrastructure. Let me give you an example. I don't know if you saw last year, Discovery ran what they called Vitality Open, which was pretty much anyone in South Africa could come and join on the Discovery platform and start engaging, getting healthier and earning active rewards and actually earning rewards. And one of the reasons Discovery is doing that is we are toying with the ideas of opening up our platform a lot more, getting more people on our platform and getting people more digitally engaged. And not just with their health though, but that's also in the insurance space. So the Vitality Open program was open to anyone as well. If they wanted to drive in their car, their smartphone would register and would pick up the data. So we're heavily investing in digital technology ourselves, but there are lots of other companies in South Africa that are busy doing that. I mean, we have some world first actual applications here in South Africa. An example of that is in Cape Town. One of the companies there developed an application for parking in Cape Town. So actually you park in a space in one of the city allotted spots, and your phone automatically will register when you parked in the kind of spot using the app, and then when you leave, it automatically deducts with your credit card. So certain world firsts are already being implemented digitally in South Africa. But certainly when I say China's ahead, they are miles ahead. Everything is done there in China digitally. Life insurance even is sold over the phone on WeChat app. So actually on video chats, that's how most advisors sell life insurance policies. So we've got a way to go, but there are companies investing heavily in that here in South Africa.
Okay, I think your question was answered. Is there the guy in the video can...
Yes, hello everyone. My name is Nana Kumar. It's my birthday tomorrow. things. So if I like get a lump sum of money,
Yeah.
maybe that party accident or
Let's hope it's not that way.
Let's hope it's not that way. Yeah. So,
the platform what discovery where you're taught how to use that money optimally, because you know psychologically if you're not used to a lot of money, you get a lot of money.
100%. So our view in Discovery, from Discovery Invest point of view, we very strongly partner with advisors because we believe, especially when you're young, even though we are all investment professionals, I talked a bit in my presentation about how behavioral biases, we're still subject to them and they cloud us. And someone who's an investment professional advisor who's been in the industry a while can really help you make the right decisions, even though, as I say, we're overconfident, right? We feel we know how to manage our money. But that's why I always point to financial advisor and say they can add tremendous value in that they can help you make the right decision. For instance, I showed hindsight bias. For instance, you might be tempted to put all your money on cash, but if you're really planning on investing for the long term, you should be investing in riskier assets. So I would say chat to a financial advisor, definitely, especially if you're young. And as much as we think we know everything, I think it's best. Even I have a financial advisor, and I think it's best to chat.
And you can link through the app and through the website.
So yes, so you go to our Discovery website. You can also check the rewards we have there, and we have contact details there. We can put you in touch with a financial advisor.
It's on the screen.
Yeah. So if you click on investments, it will pop up. Yeah. Sure.
One more question.
I know it's wrong of me to ask a question because I'm supposed to be but I will get each person that I need to ask. So with regards to the behavioral bank that you guys have launched, I just wanted to know, like, as an F&B client, leaving F&B, what value would I get coming to Discovery in the sense that I know you guys kind of say you're going to kind of give me an interest rate which is tailored to how healthy I am, right? So I just wanted to know, will it be below prime rate or will it be above prime rate?
Well, that's then the actuarial answer. Those of you in this room who know about taught, when I say the actuarial answer is, it depends, right? And the good thing about the behavioral bank is it doesn't just depend on what your position is at the beginning, right now, because that's the traditional way, right? We do a risk analysis and we look at you now, and that's what that's the class that you are, the risk class that you are allocated to. What it actually depends on is you, because it's dynamic. So that's what the unique offering is that you will, you might not qualify for the lowest interest rate at the beginning, but you've got the opportunity through your behavior to actually get there. So instead of sort of being sort of put into a box and now that's where, that's the way that you're going to be dealt with by the financial institution, you are actually first of all encouraged to change your behavior and then rewarded for that.
I think we can go down to prime -3 on credit card. I think that's up to the biggest discount. But yes, that does depend on your behavior.
Yeah.
We'll take a question from the back. There's a guy in black.
My question is directed to Mr. Daniel. I heard you talking about the digital currency. So I just wanted to know how the rise of digital currency affects central banks and banks in
It's cryptocurrency, you're saying, sorry. Digital currencies. It's a good question. It remains to be seen. That's the question. I think one of the big issues with digital currency at the moment is volatility. So, for instance, it's not practical at the moment to transact day to day with digital currencies because most of them are extremely volatile, and also people have a problem of trust with these things at the moment. So, it's going to be at the moment. I don't know if the world's ready to adopt these digital currencies, but in the future, it's definitely going to be something that's is probably going to take over. We have nations who are launching their own digital currencies. We have Facebook, which just launched theirs, which is going to be a huge thing. So I can't tell you how that might affect things because we don't know. It's a massive disruptor. It's going to be interesting to see, especially how national reserve banks react to it. It all remains to be seen. I'm not the expert on the subject, but I can just say it will be a disruptor going forward in the future. Yeah.
We're going to take a few questions from the middle. We can start here with the guy in blue.
Okay. So I see that you have a very big vision to be the best insurer in the world. So seeing it being so big and given or providing much value to people, you should surely be willing or indeed are fighting to protect it to the name. So now, what happens with our government is that they're planning on doing one
implementing the NHI. So how, it's obviously disruptive, it's like one of the worst decisions government is taking. So how do you plan to get around this and still achieve your vision of being the best insurer in the world?
So the vision of the, I'll let Roseanne answer the second half of it. The vision of being the best insurer in the world, South Africa doesn't have 100 million people, so we only like 60 million around there in that region. So the balance is coming from the growth that we're doing in our international markets. But yes, in South Africa, there are challenges in and around how we're going to navigate around the NHI, which Roseanne will speak to. But in terms of making people healthier, I think we are one of the biggest, our health insurance scheme, our health medical aid scheme, is one of the biggest in the country. And in terms of the customer base that we serve in South Africa, it's the largest. So in terms of making people healthier in South Africa, yes, I think we're gonna achieve that. I'll let Roseanne speak to it.
Well, I guess, it does actually blend with the ambition, because it's not about getting around it. It's actually about working with it, right? So, it's undoubtable that we have a massive problem in this country. We are the largest health insurer. We cover 3.5 million people. Just 3.5 million people. So what about everybody else? So certainly, it fits in well with our ambition to be part of the solution and not trying to get around it. So what we're looking for is the opportunity to actually engage with the NHI and with that development, and actually be part, bringing these tools and skills that we have developed, and actually be part of that solution. Because if we can share some of what we have learned by insuring just 3.5 million people, then we can obviously make a massive difference in terms of the South African market.
If I can also just touch on that. First off, regarding the NHI, it's important also to remember that the current NHI bill that was put forward has a lot of inconsistency at the moment. It's the first, we've been talking about NHI now for around, I think, 20 years they've been talking about it. So it's the first time pen has been put to paper in this actual bill. There's a lot of inconsistency at the moment. There's a lot of uncertainty around how it's going to work. So that's one factor to consider. But yes, we just want to sit at the table. We actually want to help the problem. Recently, in Adrian's result presentation, he kind of gave some statistics about what's going on. So ultimately, the government, there is a huge problem in the public sector, healthcare sector. It's unacceptable what's happening at the moment, and it has to change. So that's the first. Discovery wants to be part of that change and help that. Important to note that we're comparing the level of care that we have in the private healthcare system in South Africa is on par with the NHS system in the UK, right? Except we do it around a third of the cost. That's per Adrian's result. So we clearly have some of it's got to do with purchasing power parity, but a lot of it has to do with because we have brilliant administration. So we have a lot of that to share with government as well. The issue is that if we wanted to achieve NHS level care in South Africa, in the state healthcare system, that would cost us around 50% of our annual GDP. So clearly it's not possible necessarily to just change the healthcare system overnight, but certainly the point is we want to help improve it. So we wanted to see the table. So going forward, we don't see Discovery doesn't see it as a negative thing. We think we can work with government, come to something workable. I think the point is it can't just be the state healthcare system under a new name. We also have to rework that system and improve the system because the current system is not working. But I don't think it's necessarily a killer for Discovery. In any case, we have our broader ambition is to make people healthier and enhance and protect their lives. It's more than just about the profits for us. Yeah.
We'll take one question from the back and come back to the middle. Can the girl in white please ask a question?
My question is directed to Matt.
Yeah.
You spoke extensively on hindsight buying and investing, but with what information can you guarantee that you have a higher or rather increasing return in the future without any statistic from the past? And then my second question is that I read an article actually based on the fourth industrial revolution, the impact thereof on actuaries. And a UK actuary that has been an actuary for 48 years said that for as long as there's insurance, there won't be an impact on actuaries that are in the insurance field, because the scenarios that are modeled take human mind to actually be imagined or rather modeled. How true is that?
Okay, so first question, I can't guarantee anything. Again, it is statistical analysis based on past data. And I do see when we can't obviously not consider past data. I'm not saying that we should just completely throw past data out the window. In fact, past data is important. I talked about looking at the performance of a manager at a snapshot in time, right? We look at a manager and we look at their 1 year, 3 year, and 5 year return. We actually advocate, I could have done a presentation for 3 hours on top, we had so much stuff on it. But one of the things we also look at is we said what's more important is actually consistency of a manager's performance. So not just looking at 1, 3 year, 5 year performance, but looking at rolling 5 year return periods and seeing over time, is this manager consistently achieving good results? That can inform your decision, but you can't just rely on that past data. And that's what a lot of people are doing. You have to partner with other data and qualitative data out there especially. We have to look at the quality of the management teams. We have to look at the movements in the asset management teams. What happens if half the asset management team left the manager 3 months ago, but they had fantastic performance before? We have to look at other sources of data. You can't just take returns data. I hope that answers that question. The next part about the fourth industrial revolution and the actuarial roles. I can agree with that actually in the short term. But over the long term, I do think actuaries have to consider the fact that AI is going to get phenomenally advanced in the future. AI is increasingly, I mean, we saw recently Google built an AI which beat the world's best Go player, which is the most advanced board game in the world. So these AI algorithms are getting incredibly powerful and they're able to do increasingly impressive things. So there is a distinct possibility that in the future, I don't think it's the near future, personally, I don't think it's the next 10, 15 years, but I do think we'll see certain actuarial roles being kind of absorbed by AI going forward. We'll see AI in short-term insurance pricing, for instance. Let's talk about self-driving cars. How does that affect the car insurance industry? Right? What's going to be, how we're going to do car insurance when the cars drive themselves? It's going to be a very interesting future going forward. So I do think it's still important that actuaries are able to expand and do different things. And that is what we're seeing actuaries doing actually now. Actuaries are becoming increasingly malleable. There's increasingly rare to find an actuary who can't actually stand and speak in front of a crowd, which is quite an interesting thing. The field is changing and we're going to have to change and be malleable and be able to do multiple things. But I think that's already the actual field is changing to address that and becoming more malleable.
Yeah, I mean, maybe just one thing to add, think about it like this. It's not what you learn, but how you learn. So when you are here and doing your studies, it's not just about the stuff that you're learning, but it's actually that you're learning how to learn. And that you want to constantly be building on that, because then you have a foundation that you've got, but you can navigate as the environment changes.
And then one more thing to add to that, good learning, or they say the best learning is only great if it's applied. So you still got to apply those skills. And I think from an actuarial perspective, we're still going to need human minds to translate and give insights and intelligence. So we still need that at the moment.
Yeah.
So, yeah.
And at the moment, so AI is replacing things that we already understand or know, right? Yeah. Processes that we understand and know, we can replace with AI. It's a harder thing to imagine a future where AI comes up and solves new problems creatively. That's something that a human brain, certainly what the article you read from maybe was referring to.
Yeah.
So there's something to be said about that as well, the future of us being able to solve new problems and moving on to new challenges.
Okay, we'll take a question from this side.
Okay.
Okay, can the guy in the blue shirt answer?
Just want to find out, with the recent transition going to digital or mobile banking, where we have now Italian Discovery Bank and also your banking was going to be launched but delayed. What about the digital wallet space in terms of, aren't you guys threatened by that? Instead of having a behavioral bank, we have a more digitalized behavioral wallet, which is tailor-made to sort of our demographic that we use. Actually, we use payment systems which are cheaper compared to banks, and also transactional and also online payment systems which already are in place. So aren't you guys threatened by launching a behavioral bank rather than launching a digital wallet bank or digital behavioral bank wallet for
I'll answer the first part of that. It goes back to my other answer around digital currency, right? So currently, I don't think the world is ready yet for that, right? I mean, it's clear that we tried, there was the whole Bitcoin craze, but at the moment there's still things to work out in the digital currency space. So in terms of digital wallets, it's not quite there yet. So the first iteration of our launch is launching within the conventional banking system framework, but launching a digital-only bank, right, and a behavioral chassis. We want to get the behavioral chassis off the ground first. And then on top of that, we launch every year. We're a company of entrepreneurs. That's how we have an entrepreneurial mindset. So we're not worried about any future challenges. In fact, we think we're more than capable of rising to those challenges when they come. In fact, being ahead of the curve when they do come. But certainly it is an area where, watch the space, discovery will be disrupting further and forward.
But I think, yeah, I mean, it's a very good point. And it integrates well, though, with a digital bank where there's no branches. It is an app-based tool. But it's interesting that in itself is how banking has shifted, right? That, I mean, historically, the way banks made money, well, not just from the interest rate variables, but also from transaction fees. And of course, that's practically wiped out. And so the business model is not built on transaction fees. It's actually built on getting people to save and invest and grow their wealth, which is then not about transactional stuff at all. It's actually about that core base of what you do with building your savings and building your wealth and encouraging you to do that. So I guess it's a bit of both, isn't it? I mean, it's yeah.
Well, I mean, we're pushing mobile money spot right now, which is within 3 months it really has 600,000 users, and then the digital payment wallets.
Yeah. And most people will be on more than one. That's the interesting thing. Is people are not so loyal to saying, well, I'm going to choose one or the other. People will spread themselves as well. Yeah.
We believe that the behavioral platform is the innovation. That's actually what it is. Yeah. So we can build, once we have that behavioral chassis live and going and people buying into it, we can move that behavioral chassis to anything we want, digital wallets, whatever it may be. But that's what we believe in. We believe in our core purpose in the banking space.
Okay, we're going to take a question from the back there.
Hi everyone. This is a question that is not directed to anyone, but anyone in particular. But I just wanted to ask a question of with everything that I'm hearing, it seems like discovery is going to be more and more unaffordable for normal South Africans. And I just want to know what is discovery doing about that, because when you look at the current unemployment rate, when you look at discovery, you're like, that's the type of insurance I want for my car when I get my honors degree or something like that. But that's not really possible when 30% of the population is not working. So what is discovery doing about that?
Yeah, it's a good question, but I think it's interesting because what you're saying actually speaks to the brand that's been developed, right? So it sounds like you're seeing Discovery as an aspirational brand, but are you making those comments based on that brand, or the brand that you see, or actually based on looking at what the cost of the products are? So when you look, for example, at Discovery's market share in the healthcare space, the market share is actually greater in the entry-level options for healthcare and for health insurance, and even sort of lower-cost health insurance that is written through the life license rather than through the medical scheme. That's actually Discovery's market share is greater in those segments than it is in the higher income segments. And the reason for that is because by starting off, in that higher margin segment, you've then got the opportunity to then enter into those, into the more cost-constrained segments. So I guess that's a basis which, flowing through the products that's the opportunity for us to build on. But it's a massive challenge for our economy. I'm not going to say that we have the solution, but if it is our ambition to grow, it is a challenge that we have to overcome.
I can say that some things we've done to address that recently. I mean, last week we launched a new health plan aimed at the low-income markets. So we're continuously trying to open out more and more and more. And I mentioned last year we opened up the Vitality Open program, which anyone could join for free. And then all they can do is exercise and they get rewards for free. And as I said, part of that is trying to get people into the platform and trying to get people engaged in the program. And we've launched other variations of Vitality programs, such as Vitality Move, I think, which has just changed names now, where I think it's only, how much is it, 59 Rand a month, I think, for a form of the Vitality program. So we're trying to open that out more and more into the different markets. If you actually look at the base costs of our product range, we have across our product ranges options for the low-income market. And the behavioral model we built is not something necessarily you're paying extra for. We believe the behavior change itself funds the benefits within them. So all the prices you pay for them, you'll notice, are very marginal compared to the benefits you can get out of these programs. So all of it is kind of geared towards making it accessible to everyone.
Okay, we're going to take just 2 more questions due to time, because I think we're also on the course that we're only supposed to keep you here until 7:30, right? So we'll take a question from the guy in the black sweater here in the front.
Hi everyone. My question is directed to you. As a partially behavioral psychologist, I was interested in how the behavioral change influence the people on the decision they make, as well as beneficial to the company. So on your last slide, you showed how change in behavior of your clients reward them. So I want to know, like, when you arrived to your that model, it was based on the analysis you made, like based on how people were changing their behavior, it was beneficial to the company. That's the first 3. Or you went to the route whereby you hypothesized first by saying, if we put this in place, like change in exercising, the healthier they become, the lesser they play, then you saw that it will benefit the company and it will also benefit the clients. The last part where, like, after you have proposed that to your clients that if you do change in behavior, claims, you have this rewards, like how you went about coming with that model.
Yeah, it's interesting. So when we first launched this model, I'll be honest with you, we took some risks. I mean, we took the risk that people would change behavior to achieve these rewards. But when we first launched the program, it's kind of, you build a puzzle piece by piece, right? So we started with basic actuarial pricing. We said, okay, if a guy stays so long, we built in actuarial lapse rates, etc. We calculated certain boost benefits we can give up front to people to entice them to stay longer. So we calculated a product that was actuarially sound, even on a base case, right? And then over time, as we saw behavior changing in the model, and as we saw people actually, these incentives were creating behavior change, that's how we managed to tweak the product more and more and more as we played around. We sort of, it's experimental model, over time. As I said, that's the nature of the entrepreneurial nature of our business. So we took some risks launching out front, because we saw this behavioral model play out in the rest of the business so well. And over time, we just kept on adding it to it now. And now we have this actual and established behavior framework across different behaviors. And we believe the 4 behaviors I showed earlier, which is investing longer, investing more, withdrawing less, and living well, those all feed into not only the profits we make, because if people stay longer and invest more, whatever, we have more assets under management, but also it completely changes the client's outcome. It's better for the clients. So we found this magic recipe, something that's good for the client and good for us. And as we keep the relationships to cycle, it's a cycle, we just keep on adding to it. So yes, it was an experimental thing, over time. It's an ongoing thing. It's ongoing. We keep on launching new things. So.
Okay, our final question will be from a female, because you're the last speaker. You can ask your question.
Okay, my question is, so my question is, why is Discovery the only bank that chooses behavioral banking? And secondly, why does the world need a behavioral bank? And the second question.
Well, I suppose it's the only one because it's the first one. So everywhere where Discovery leads, perhaps some others will follow. And I guess the proof will be in the pudding, right? So as the experiment plays out and the success is delivered, then there will be, perhaps people will follow and modify, and the trick is to stay ahead. So I guess, you talk about a control cycle approach to any project, which is that you have to obviously plan it well, you have to understand the market and the environment that you're going into. You have to do the planning, you have to do the scenario testing, but then very importantly, you have to do that monitoring. And that's where I guess this building, making sure that we've got the skills in the organization that are going to not only be able to analyze this data, this large volume of data that we're accumulating, but also be able to make those judgment calls about what to do with it. Like, what are we going to tweak to make things work better and to address problems as they arise. So that's where the kind of agility part of being able to react and respond comes in. Does that kind of...
Yeah, so he also asked why behavioral banking.
Oh,
so
yeah.
The why behind it goes back to our shared value model.
Yeah.
Right? So we've seen the success of this model across the business. We understand that when clients do stuff that's good for them and it ends up being good for us, then we can reward them for that and create the cycle of value. So naturally, we wanted to be the first in that behavioral space. We wanted to take the shared value model and be the first to it. And so it felt natural where we do behavioral health insurance, behavioral life insurance. So it's a natural extension of our business model into behavioral banking.
And it's also about sustainability. I think just to add on to that, we also want the behavior to be sustainable and sustained, because that's where you get the value. You unlock the value over time because if you sustain it. So I think that's also critical.
Okay, we're getting our final question from the lady at the back.
Hi everyone, my question is for Cynthia from the Wits HistoryMakers. When she started, you hear it? So when she started, she said that they started the program at the beginning of the year, but she never really elaborated how you can get involved with the different courses. So can you just please touch on that? You can come to me.
Questions towards the societies, you can ask them after the event.
My last question is for the last lady who presented from Discovery. It's about the Future Leaders programs, the Adrian Bull Fellowship.
Yeah.
And then it says that top 5 students per University Johannesburg into selection process. I'm assuming it's for all students, but will that still be running 3 years from now? And like exactly how do you
That's ambition. Yes, it will.
It's ambitions and period, but sorry, your name is sorry. It's ambition, but do you know something we don't know about 3 years from now?
Yeah, you'll be there.
I can just, if I can say, based on what I've seen from the Actuarial Fellowship course, it's been, I think, a tremendous success, and not just for us for the business, but the candidates who come into it. It's fantastic exposure. I don't see possibly it ending in the next 3 years. I think it's a thing we
Yeah, no, it's a long-term commitment, so it's going to continue, and in fact we have been talking about ways to
enhance it,
to grow it and enhance it even more. So
yes, to answer your question, yes. Honor students, yes, and we also, as you know, on campus we invite 3rd and 4th year students to our campaigns. So watch out for us. We will be coming through next year in February. We're already booking our dates. So we'll be here. But I wanted to say to the entire team or the entire group, that's one pipeline of how we attract our talent through the Adrian Gore Fellowship.